here we go with problem number one, the WACC, weighted average cost of capital. Very simple equation, as you can see here. We'd have done that already. The weight of debt, weight of equity. The question told you that the capital structure had only debt and equity. The WACC equation, the general equation, would have another piece, preference stock. But our problem doesn't have preference, it just has debt and equity. So that's all we need. The debt, as usual, benefits from a tax concession. So 1 minus t, where t is the tax rate, applies to debt. Nothing like that for equity. The weight is a relative amount of debt, weight debt, relative amount of equity. And so we were given some figures. We were told that the cost of debt before tax would have been 13%, 0.13. The tax rate was 40%, 0.4. The equity, cost of equity was 16%, 0.16. But we still don't know the weights. But we can find them because we have the total capital structure of the company, 2,880. We have the amount of debt, and so we simply express the weight of debt as the relative proportion of debt in the capital structure. So we do the simple division and we end up with 0.4, 40%. We didn't need to do the other one because if debt is 40%, we would know that equity is 60%. But we do it anyway and we get 0.6. So now we have the weights of debt and equity. We put them in. Simple arithmetic gives us the weighted average cost of capital as 12.72%. Pretty simple. The other problem is a little more complex, but let's go and we will see just how complex. We had already given us the simple method for valuing financial assets. The first thing is to identify all the cash flows that the asset generates. Step 2 is to discount them appropriately. And step 3 is to add them up. Our problem, the cash flows are dividends. And they gave us one. The dividend already paid, which makes it D0. So we put it at time 0. But that's the only cash flow they gave us. We need then to find the others, and we could find them pretty easily. They gave us the growth rates. The first 3 years, the growth rate was accelerated or high growth rate because the company enjoyed a comparative advantage over its competitors. So it could charge a little more for its products and would make a little more money. First, it projected growth rate to be 16%, next year 14%, the following year 12%, and after that, they expect the competition to have caught up with them and their growth rate would fall to the industry average, a constant 6% thereafter. So we don't need to have more than year 4, and you'll see why. We could have put year 5 and year 6 and year 7 and year 8, but where would we stop? So with valuing equity, we can't count the cash flows on our fingers because we don't know when they end. So we adopt a different method. And this constant growth part of it is key to understanding what's going on. You will see the arrow pointing to year 3 and denoting it as the terminal or horizon year. Year 3 is a special year. Why? Because the period of accelerated growth ends here at year 3. And the period of constant growth begins here at year 3. Each of these, accelerated growth, constant growth, generates a cash flow. And so year 3 will have 2 different cash flows. I should point out that although in this problem, the cash flows are dividends, they could be anything. They could have been revenues. And instead of $2.95, it could have been millions of dollars. So it could have been revenues, it could have been profits. So if you are valuing a company, you could use dividends per share, yeah. But you could also use the net income or the cash flows or the revenues. We treat them in the same way. They are just cash flows and we identify them in the same way. So although the nature of the cash flow is different, and in this case it is dividends, it really doesn't matter. The cash flow could have been anything. We treat them the same way. The terminal value then, P3, since year 3 is our terminal year, the value we calculate for the terminal value is going to appear here at year 3. So year 3 will have a second cash flow. So we calculate our terminal value. Although we didn't put the general equation, you are familiar with it. It would have been P0 equals D1 over K minus G. That's a general equation. But of course, it is the constant growth equation, and it only applies where growth is constant. And in our particular problem here before us, growth is only constant from year 3 onwards. So the general equation P0 equal D1 over K minus G becomes P3 because that's where constant growth starts. Then we need the first cash flow of the constant growth period, which would be D4. K minus G, G would be the growth rate, which we have here as 6%, and K would be the cost of capital or the discount rate, which was 10% according to the problem. So our problem is set up. Simple arithmetic gives us a terminal value of $115.75. That also is at P3. I left it there, here, but it also belongs here. But we didn't want it to be too crowded. Besides, we did a similar problem the other day, and you can look back at that. But this 115.75, the terminal value, belongs to year 3 as well, because it captures the value of all cash flows after year 3. So we don't even need to know whether the company survived to be 10 years old or 50 years old or 100 years old. It doesn't matter. Because it is the constant growth period, we apply the constant growth equation and we find the value of all the cash flows of the constant growth period, which is 115.75 in this case. But we want to find as well the current price, P0, the price at time 0. So we set up the equation for P0, which is here, which means all the other cash flows have to be brought in now. D1 is $3.42, D2 $3.90, D3 $4.35, terminal value $115.75, which is also a year 3 cash flow. So we discount them, N is 3 in both cases. So we replace the symbols by numbers. We discount these numbers appropriately, which will be the second step. So the year 1 cash flow is discounted only 1 year to its year 0 value. The second year cash flow, $3.90, is discounted by 2 years back to its year 0 equivalent. The year 3 cash flows, of which there are 2 of them, the dividend represented or originating from the accelerated growth period, 437, discounted 3 years back to its year 0 equivalent. And the constant growth value here, the terminal value, also a year 3 cash flow, discounted back 3 years. So at this point, all of these cash flows, year 1, 2, 3, have been discounted to their year 0 equivalent. So we have discounted them appropriately. Then the third and final step, we add them up. that plus that plus that plus that gives us this. And this then is P0, the current price of the stock. Thank you very much.